Okay, I believe it says we're recording here. So, okay, so good morning, everybody. And this presentation for the MTS group of Dallas is about Merlin AI, which is a algorithm add-on on top of Sector Surfer. And we're going to be talking about the Bull Rider Bear Fighter portfolio, which is the primary offering in our Sector Surfer, Alpha Droid, and now Merlin AI Corporation ETF. So, of course, we have to say the disclaimers, and they're here for your speed reading. You all know them already, so we'll move on. And the plan today, then, is to start with a brief summary of our base technology. We won't dawdle on it too much. Most of you have seen it. Then how artificial intelligence will help, a summary of how Merlin AI works, the Merlin AI strategies and portfolios, using Merlin AI within Sector Surfer, why artificial intelligence is missing in action on Wall Street, and the Bull Rider Bear Fighter has a paradigm shift. So some of you have seen that the Bull Rider Bear Fighter is recently in the news. It is an official index, and it's an index that underlies the ETF. And we'll get through to that here eventually. And to look at any of this stuff online, you only have to remember one thing, and that's that Merlin.ai is an official URL. You can throw the www in front of it. But starting with Merlin.ai, you get to this page and you see that Merlin AI is a technology, and it's also a company. And so and we're going to concentrate on the technology. Some or most of you probably know that technically I'm only allowed to really talk about the technology, as I am not a licensed securities dealer, so they like to restrict what you say about ETFs, and that they are connected. I am allowed to answer any questions you guys ask, but I have to focus on the technology and the index. So anyway, if you click the learn more thing, it takes you to another page which allows you to drill down. There's some videos on the page for the background technology, and then underneath that it gets into the strategies and portfolios posted on Sector Surfer. And of course, underlying the first part of the technology is the good old stuff you guys have heard about before, the Sector Surfer stuff, which is all detailed in the book Conquering the 7 Faces of Risk. And I'll just state that if you don't want to go spend $67 on this book at Amazon.com, which is what it costs, it's a costly book to produce because it's got a lot of high resolution, high quality print pages, and of course everybody wants their markup in it. But if you just Google the name of the book, Conquering the 7 Faces of Risk, you'll find that there's a PDF copy online that you can just download for free. So my objective never was to try to make money on a topic that most people feel dry. There's going to be so money made here, so it's more important to me to just spread the word and try to help people. Okay, so Merlin AI, what is it? Well, it builds on, and I say it does not have to discover other existing knowledge. For example, it does not have to reinvent Sector Surfer from scratch. You're going to hear me say that over and over, and that'll become more apparent why in the end. So Merlin AI accepts that momentum exists in market data. 1993, Jagadish and Tietman had their academic paper that really showed that it was there. And shortly thereafter, and well, I guess not shortly, Eugene Fama even bent to it and agreed, yes, in fact, momentum does exist in market data It's above suspicion. He can't find any way to discount it. So Merlin AI accepts this. Merlin AI is not going to try to rediscover momentum. Most important to me as a signal processing engineer is this guy, Claude Shannon. He was a Bell Labs scientist, and in 1946 he wrote a seminal paper about signal-to-noise ratio, proving that signal-to-noise ratio controls the probability of making the right decision. Obviously, seeing a little bit of the road ahead, a little bit more, changes everything. So the fact that signal-to-noise ratio is important, and it's a concept that exists, and you got to deal with it. We're not going to ask Merlin AI to rediscover this. Okay, but now that you've discovered that signal-to-noise ratio is important, what the heck are you going to do about it? Well, it becomes job 1, job 2, maybe even job 3. If you're not going to get the noise out of the way, you're not going to hear things right. You know this when you're in a sports bar and your wife or sweetie whispers to you in that soft voice the honey-do list, and if you don't get that honey-do list, you're in trouble. Or if you're a pilot and there's too much noise on the radio and you don't get the information, that can be a bad thing too. So once you know that signal-to-noise ratio is important, you better the hell do something about it. And unfortunately, when you go through all the academic papers about momentum, nobody seems to look over to the other departments in the universities, like in engineering, where you look into signal processing. Back in the 1950s, when modern portfolio theory came along, we could hardly talk to the other side of the country and say hi to grandma. It was a very difficult kind of task. But today we're controlling rovers on Mars, and it's just astonishing what's changed. So there has been mathematics that have changed since modern portfolio theory, and one of them is matched filter theory. And when you get into it, it shows that there actually is a way to design the momentum filter for optimum performance. Because I can tell you that it did not come from the universe or God or Allah, that it's 12 months exactly with even uniform allocation as the simple moving average as the optimum filter for momentum. Where did that come from? Exactly 12 months? Here it's important, the next day it's not important. That's optimum? No, it's not. Somebody pulled that out of, who knows where they pulled it out of. It started with, I think, Jagadish and Tiedemann, maybe even before that, and everybody else has copied it since then. But if you're an electrical engineer and you go apply matched filter theory, you find that the optimum matched filter is much different, and the removal of the noise is significant. Merlin AI accepts matched filter theory exists. We're not going to ask it to reinvent this or rediscover this. Also, job 2, reduce the noise in some more ways. What every electrical engineer knows is that you have to use, when necessary, such as in USB and Ethernet and many other signaling methodologies, a method called differential signal processing. And very simply, here in this chart here, showing a bunch of different sectors, you can see a bunch of these things moving up and down at the same time. That's common mode noise. You don't want to have that common mode noise in your decision process. If you're using some kind of a trading platform that looks at one thing at a time, it means you've not removed the common mode noise, and you will have more noise in your decision process, and you will make poorer decisions. This is why Sector Surfer always looks at many things at the same time and does the comparison between them. The comparison is inherently a subtraction, and that subtraction is what you need to remove the common mode noise from them. It takes the difference between them, which is what you see in the trend signals down below. Merlin AI accepts this. We're not asking Merlin AI to rediscover that differential signal processing is important. once you've decided this and you say, oh, gee, I want to beat the S&P 500, and you just look at this simple chart, which is sector trends over a 10-year period, and it's showing the rolling monthly returns of various sectors in the various colors with the S&P 500 in white. And as you would expect, the sectors always have some better than the S&P and some less than, because in the end, the sectors add up to the S&P. So if you're going to beat the S&P 500, you better darn well be somehow in the sectors that are trending better than the S&P 500. So the game for winning is being in the trend leaders. Merlin AI accepts this. We're not going to ask Merlin AI to rediscover this. Also important, and many of you have heard that we have the so-called StormGuard Armor methodology within Sector Surfer, and it's just a methodology for getting out of the market's bad. In the gray here, we're showing the S&P 500. Originally, when the Sector Surfer came to market, we had so-called StormGuard Standard, and it had a performance, a fairly simple get out of dodge methodology, which was similar to, but a little better than the Death Cross, which is the 200-day, 50-day crossover. In 2016, we improved that and decided to look at 3 different market indicators, which included market momentum, and with momentum that talks about what is the volume or the force behind the movement. Also, what's going on with the people who are playing at the highs and the lows, as well as the regular price trend. So we look at 3 different things, roll them together, come up with a better view of what's really going on in the market, and that's the green line there. We're not going to ask Merlin AI to invent a new kind of get out of dodge methodology. Not going to rediscover it. One other thing, of course, once you do get out of dodge, are you going to sit in cash, or are you going to do something better? So there's another concept that we call an integrated bear market strategy. And why have a bear market strategy? Because over here on the left, as we show U.S. stocks and treasuries or bonds are not always correlated the same way. They change over time. Same between the correlation of gold to the market. It changes from time to time. So if you're going to pick something, you can't just say, I'm going to go into bonds or I'm going to go into gold, because you don't know whether it's going to be favoring you this time or not. So the thing to do is let's look at a bunch of things and have it pick whatever the best thing is. So it's a strategy for bear markets using bonds, treasuries. This one doesn't happen to have a gold component. And you can see that in 2001 and 2, 8, and 9, by looking at these things and picking the best of those that is trending the best, you can actually earn a little money, not just sit out in cash. So we're not going to ask Merlin AI to reinvent the need to have a wholesale change, and now we're going to consider these defensive things and that it needs to evaluate them. We're not going to ask it to discover that you can't rely on these things. We're going to ask you to accept these things. So now I'm going to show you a series of charts. One of the things that occasionally I run into is people see the starting point, which is all the sectors with the S&P 500. So here we have a whole bunch of the basic 9 spider sectors plus a few more, because we have 12 positions. So we put a couple more in there, and they're all plotted in gray here. And the color that's plotted in this line here in the equity curve is the color of the thing that it's holding at the time. The white line here is the S&P 500. And I'm going to take you through step by step what the meaning of each of these things is. So you see it from the beginning to the end. It's too big of a step for a lot of people to swallow, but it's really an improvement made up of a lot of important little steps. It's not just one big magic thing. So here, the candidate ETFs in gray are selected based on their 6-month simple moving average strategy in what we call a painted path. So we're going to start with one of the academics' methodologies, which is to use a 6-month simple moving average in a bunch of sectors. And so this is what that gets you. If you say, well, how about the 12-month? More people actually use the 12-month. So the 12-month is pretty much the same. It's actually a little different. It actually kind of falls apart recently. And so if we move on and say, okay, now let's use this signal processing methodology. And we're going to do it with, as some of you have heard about, our forward walk progressive tuning methodology. And it uses a double exponential moving average, which is what matched filter theory tells us is much closer. You see now we have an improvement. Getting more of the noise out is important. Next step is using the death cross to move to cash. So you see these white lines here where it goes flat. Okay, so that's using the 200-day, 50-day moving average to move out. So let's go back one. Okay, that's without it, and you can see right in this area where I left the pointer, it's going to go flat. So everything else remained the same, but getting out of Dodge helped us a bit. Okay, so now let's use Storm Guard armor. And maybe I'll put this guy off at the far right so we see what its elevation is. So here we're using Storm Guard armor, and it makes a better decision of when to get out of Dodge. And it's a case of you win by not losing. You get rid of more of the down stuff, and just by not going down, you do a lot better. So now we're up here. So that's another little step. So now let's say, let's not just sit on our thumbs in cash, but let's move to the bond market, to a bond fund BND. So we did a little better. There's not a whole lot of juice in just plain old bond. So now let's go one more step. And this goes to a treasury, TLH. I believe TLH is the 7 to 10 year treasury. And we're just getting a little more juice during those bad times. Okay, that's, by the way, that's been good for us recently during the last decade or so, but treasuries and bonds have not always been with us. So if we say, okay, let's actually go to a bear market strategy. You see we have another bit of a bump. So now we're looking at treasuries and bonds, and let's see, bear market strategy W. I think it has a component of gold that it's allowed to go into. And then I think finally is it's a more aggressive bear market strategy I call BMSG. And behind it is, if you go look at the BMSG bear market strategy, the full name is bear market strategy Goldilocks and the three bears. So there you get a strong component of gold you're allowed to go into, and the bears include being able to use inverse ETFs like SH inverse the S&P 500. And all of these last little things you see during bear market strategy we're actually doing quite good. We've gotten just more and more aggressive. So if we just go down one by one, go down and see each of the steps on the way down, go back up. Each of these things are just little incremental steps. Okay, so these guys that I talk about in the book with all of their pieces of technology that have come about since modern portfolio theory and have to do with signal processing and these kinds of things are what has gotten us here. This is the same strategy here. And so we're going to say Merlin AI is going to accept this, and rediscovery is not necessary. Okay, but is there more? What the hell are we here for if we got all this already? Well, yes, there is more. What about selection bias? And so if we take that same strategy over here, and now if we were going along during this period of time and we said, oh, isn't that hunky-dory and nice, and for a bunch of years, maybe who the heck needs healthcare and energy? What has it done for me lately? It's done nothing for me lately, so I'm going to build a strategy that takes it out. So over here, we've removed healthcare and energy, and when you take out those parts of the market, and you see there's times when you get a flat tire, if you will. And so this is a mistake of hindsight selection bias. You only put in the things that you think you need and not the other things. And so this is a problem. So speaking of hindsight selection bias, just for a moment, there's a couple of ways to deal with it, and actually the strategy on the left actually already does deal with it. So the usual kind of little fake conversation, I like to explain this by, I say to some guy in finance, hey, look at this great strategy. It does da-da-da-da-da-da-da, and isn't that great? And the professional says to me, well, that's nice, boy. That looks pretty wonderful there. But when did you select those candidate ETFs in your strategy? And I pull on my collar and say, why, yes, just yesterday. Thank you very much. I picked them out yesterday. And of course, then he says, well, that just means that you cheated because you used hindsight selection bias. You included the things you knew would be good, and you left out the things you knew would be bad. And therefore, you included bias based on hindsight when you just selected these things yesterday. You cheated. And so one way around that, of course, is if you think of the 9 original SPDR ETFs, how were they designed? Well, interestingly, they were designed by those smart guys over there at State Street. Actually, it was somebody else, and they sold it. But anyway, the original guys decided they were going to represent the whole market, and they used definitions of sectors that were used by the academics for something like 100 years. So they used the same definitions that the academics said, this is how we organize the whole market, and every piece of it is in here somewhere in these 9 sectors. So the SPDR guys went off and used those definitions, and they therefore included everything. And so here's a strategy that includes everything. So by including everything, you can't say something was excluded, because everything's in there. I didn't take out anything that might have hurt it. Okay, so but over here we took some things out, and when you take some things out, there are times. So if we go back, it's not that many slides. Well, maybe it is a lot of slides ago. Whoops, that one right there. So the market does move. Over here we've got the green guy and the red guy are hot things, and over here the red guy and the green guy are the bad things. The orange guy's hot over here, and the orange guy's not so hot over here. So we have rotation. Some people like to say there's a cyclic nature to that, related to the market, and various sectors do well. I think that's an interesting thing. We don't see quite such nice cycling here. And I would say that in technology, when Steve Jobs decided that he was going to design the iPhone or the iPad, I don't think he looked at the chart and waited for his turn. He just did his thing when it was time, and he drove his sector. The energy people didn't look at the chart and say, well, we're talking about fracking, but, we can't do that for another 2 years because it won't be our turn for 2 years. So I don't think it's really quite so clean like this, but they do things at different periods of time. And if you fail to have one of the major sectors in your strategy, you're asking for trouble. So I really kind of think that in my mind the model is that there really is so much money in the market, and it sloshes from sector to sector. Steve Jobs says, one more thing, I've got an iPhone, and money sloshes away from some other things over to the iPhone. Somebody says, we've got fracking. And, okay, iPhones are old hat, so we lose a little money out of Apple, and it goes to the fracking boys. And so if some part of the major sectors gets attention and you don't have it in your strategy, then you're going to have a flat tire. So now let's go back down here. Ooh, that was pretty good. Hit it on the nose. Okay, so this is a problem. And a problem that goes with this is, let's talk about XLV. What happened to XLV healthcare? Well, XLV, wait a couple of years from after XLV's development, and now we have not only healthcare in general, but we have pharmaceuticals, we got biotechnology, healthcare equipment, healthcare service providers, and so they've subdivided it into 4, maybe more sub sectors, and that's been done for pretty much all of the other guys too. So now they've proliferated, and of course we may say, well, we like the pharmaceuticals best because it's been pumping well, and if we take XLV out and put that in, or take XLE energy out and put some other natural gas thing in, or something like that, then we are leaving out part of the energy sector. And now we're excluding something, and we're committing the sin of hindsight selection bias and asking to have a flat tire possibly sometime in the future. And so this becomes a problem because we really like all these subsectors, and there's just so many of them, and so it's easy to leave some out, and it kind of goes beyond what one can do with a handful of things. So we need to be able to look at a much more broader set of things if we're to do this right, and include all the subsectors and all the other juicy things that we would really like to put in there. And so what is Merlin AI? So it is a genetic algorithm that we're going to layer on top of a strategy. And why are we going to do that? We're going to do that to evolve its set of funds each month. So it's always got the best ones. And that will remove hindsight selection bias by this evolutionary process. And of course, we're doing that to achieve better future performance. And this means, of course, that fund selection then becomes automated. And it also means that if you like having your hand on this control knob, if you're going to use this, you must submit to a higher power, as I like to say. And of course, that's Merlin. We're going to ask an artificial intelligence in the form of genetic algorithm to look at all this stuff for us and find the stuff. Okay, so what is artificial intelligence? AI, by definition, if you boil it down in Wikipedia, it says it's the ability of a machine to perceive its environment and take actions to maximize its chance of success at some goal. And of course, here we're going to apply that into investment. So can a machine perceive its environment with sector rotation, bull and bear markets? Can it see these things, that it can take action to maximize returns and minimize risk? Well, of course, we'd like to say yes, it can. And so when you also go to Wikipedia and look for different kinds of AI algorithms, this is a cut and paste from Wikipedia. There's like 200 things here, different kinds of artificial intelligence. These days, we're pretty much hearing about only one thing, in the markets, and that's the deep learning neural network kinds of things, the machine learning, and that's in here somewhere. But there's lots of other types of artificial intelligence that are out there. It turns out when you take a look at all of those things, it turns out we for a long time had two things considered artificial intelligence for a long time. One of them is called forward walk progressive tuning, and that's a way we can adaptively change the algorithm based on the past character of data. So it walks through out of sample data, walking forward to tune the algorithm, and that's been in there since 2012. So that's an automated adaptive algorithm. Also, it turns out that what we use in StormGuard armor is also considered a form of artificial intelligence. While I said there are three things that it looks at, there's actually sub-pieces that it looks at. There's actually 14 underlying measures that it has to consider and roll together to get to a final decision. Some of it's logical, some of it's analog, and that becomes fuzzy logic. So that's been there for quite a while. So the new thing here is on Merlin AI, and we're going to use a genetic algorithm to evolve the candidate funds in a population of momentum strategies to eradicate remnants of hindsight selection bias. Now there's a mouthful. So I like to maybe think of it as similar to this guy up here. This was forward walk progressive tuning, having to do with how you tune your momentum algorithm and what data you can use. And this one here is going to kind of do the same thing. Instead of tuning data, it's about who are the candidates and when do we select them. So what I sometimes like to call this forward walk progressive picking, because we're going to evolve the candidates month by month. Okay, so there's a lot of slides I could show you, but it turns out rather than listening to me go blah, 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 we made this interesting, fun little video here. Let's see, I hope it'll play through well. It's just a short 2-minute thing, and it'll save you a lot of time listening to me. Let's see, I'm going to see if we can get that played here.
As investment managers, what we think we know and even our past experiences and intuition can place limits on our profits and consistency. This is what we know as hindsight bias, and it affects everyone. Merlin AI is a tool that can eliminate hindsight bias and give you more profitable and more consistent results. Merlin uses genetic algorithms to create and consistently maintain the best strategies. Using Sector Surfer and AlphaDroid's data and knowledge, it intelligently analyzes and selects from hundreds of ETFs in a specified portfolio and assembles them like DNA into 12 parent members. It then selects the best members and crosses and mutates them together into even better child members, using only the best performing fund's DNA from each. Merlin then selects the best ETF from that group. Each month, the AI will continue to evolve each set, replacing each member with better and better members, which will thrive in the current market environment. Although you don't ever have to worry about operating it, here's a quick overview of how Merlin works. It starts with a base portfolio of ETFs and then populates the initial strategy members with the best qualified of those ETFs. After analyzing them, it creates mutations and crossovers of each. The whole mutation and crossover process is controlled by specified settings like generation offspring, mutant diversity, suitability and behavior, as well as selection bias and member fitness. Once all the best members are selected, the AI then selects the best ETF choice within the overall portfolio to create a strategy of strategies. Merlin AI automatically adjusts filters and thresholds and leverages StormGuard armor and bear market strategies. Merlin continually repeats this process, making for greater consistency, better returns, and dramatically less risk than manual management. Merlin AI, the smartest investment tool you'll ever use. Contact us today to learn more.
Okay. So let's see, get that away from the microphone there, and oops, it jumped out of the whole presentation here. Let's see, Shift F5, get us back, and there we go. So here actually on the screen is that application that actually runs the genetic algorithm. And what I'm going to do in just a moment, I'm going to click this thing because it's a 300 times time lapse of the complete evolutionary sequence from 2004 up to present for a strategy 5 called Sector Nectar. Some of you are familiar with this. And just to let you know what some of the things going on is going to be, when I start this, maybe I can start in, okay, I'm going to stop this here just for a second. So you see here there's 12 member strategies, and there's lots of details underneath, but this is just a little summary of what's going on. And each one of them have picked their momentum leader, but each one of these strategies, like a sector surfer strategy, is composed of a set of ETFs, and they are made slightly different. But they all have the main sectors. They all have, for example, some kind of a energy or technology or healthcare type ETF. But there's lots of those kinds of things. So they're each a little different. So the reason to, or let's say how this really evolves, it may sound complicated, but every one of you know how people and bunny rabbits and corn evolve. The genetic process of mutations, where something is slightly different, and the other process is the crossovers, where you can, for example, this guy here might have a XLV, and this guy here has IHI for its healthcare ETF component, and they could just trade. This guy says, well, that guy's doing better than me. Maybe I'll steal his healthcare guy. So it's mutations and crossovers, just like people. And as you move from month to month, these things evolve, trying to become stronger and stronger. So when they mutate, when this guy mutates or has a crossover, if the child is better than the parent, it replaces the parent. Just like in humans, just like in corn. And so over time, then it brings in the new things. It's always only looking at things that have actually passed. It can never decide to evaluate something at, let's say, in 2010, based on information it knows from 2018. It's forward walk, progressive picking. So when I click this thing, you'll see the equity curve build itself. You'll see all these guys switching around. Up here are the first, second, and third picks that it gets off of these things, because these things go into the so-called strategy of strategy, which determines the final picks. And you'll see a rolling return thing generated across here. So let's click the thing here again and let it switch off or go across. And the places where it's orange over here are where the bear market strategy kicked in. So I'll just click that one more time. So all of the strategies within the bull rider, bear fighter, and Merlin's magic operate in this kind of fashion, and the hindsight selection bias is removed. So let's go a little further. So in this, so the very first Merlin portfolio that we made was called Merlin's Magic, and it consisted of 4 underlying ETFs. Sector Nectar, which was a sector-based thing. Global Domination, which was regional parts of the world. ETFs for example, Europe, Latin America, North America, etc., and finding the best one of those. Factor Faves. Most of you are familiar with investment factors, the academic investment factors, which of course include size, value, dividends, and a few other kinds of factors. And it takes ETFs named with those kinds of things. Dividend ETFs. Okay, well, that is a factor. So let's find the best dividend, the best, large cap growth ETF. Style box is similar to factors, except for it's limited to usual 9 boxes in the Morningstar style box, which of course goes from small cap to large cap, and then value and on the right and growth on the left in 9 boxes. So finding the best of the style boxes. And so let's see, when you then look at each of those strategies. So here's strategy charts for them. Here's all of the ETFs that it considered in these colorful areas. And when you create a portfolio out of these things, it's actually a very good thing to include what I call divergent strategies into a portfolio. They're divergent because, for example, in Sector Nectar, we've got all these sector ETFs, and it's picking and rotating between them. So you would expect the bumps on this equity curve to be different on the bumps of the equity curve for global domination. Not only the small bumps, but also the curvature and stuff. The style box and the factors actually are going to be fairly similar because they have a fairly similar base, but they're a little bit different. But these guys are different than those guys. But when you roll them together in a final portfolio, you get the benefit of standard old diversification. You have diversified strategies that you've rolled together, and you have a smoother equity curve, both with its dips and wows, and also in the little minutia. And so this came to market in on our site in September of 2018, and it's been on Sector Surfer, Alpha Droid, and Riskalyze since then. And just a quick thing of how to use that. So if we come to Sector Surfer, so here's a Sector Surfer page, and there's my little pointer guy. So if we say we want to click on the blue S, which is a selected strategy, we click on that, the thing pops up, and let me get my little pointer thing here, laser pointer. So we put MERL into this box here, and everything with MERL shows up here and selects on. And if we want Sector Nectar, then we click and highlight that. So we can highlight that, and on the bottom right, use selected, and that comes on in it. If we want to see its chart, we click the chart icon, and the chart pops up, and there it is. So implementing these things in Sector Surfer is pretty easy. All of the underlying things are there. Okay, so where did we go since then? So we actually created a sister company, if you will, called Merlin AI Corporation. And so in January of 2019, so exactly one year ago, we finished the paperwork on forming Merlin AI Corporation, and its purpose was to raise $2.5 million and exclusively license from SumGrowth Strategies the Merlin AI technology for the purpose of creating and marketing Merlin ETFs. And we have done that. Merlin AI Corporation paperwork was done in January 2019. The raise of the money was done through I think August it was, and in the process then we started operating the company. So if you look at the map of what's going on here, here's the new company, Merlin.ai Corporation. And here's SumGrowth Strategies with Sector Surfer, Alpha Droid, and a little new service which we call MAI indexes. So it's it's just an index for publishing, but it's what gets delivered over to Merlin AI Corporation through a license. It's got investors. It has a company called Solactive, which is a German company, which is a so-called calculator and publisher. It's a third party that takes this index and publishes it out there. So you can go on Solactive and you can find Bull Rider, Bear Fighter. and then it's going to market these, and we'll do various kinds of Google AdWords, and we've actually had an ad running on CNBC in the morning, a bull rider, bear fighter ad. Some of you might have actually seen it. Well, actually not. We have not shown it in the Dallas market yet. We're still experimenting with how and when to show it. So Merlin AI Corporation is a thin company, meaning its purpose is to orchestrate this stuff, and the actual execution of an ETF is a very complicated, messy thing. And some of you may be familiar with Alpha Architect and Wesley Gray. I know Wes Gray has spoken to some groups in the Dallas area, and probably some of you have seen them. And starting in the year about 2014, a new kind of business came into being, sometimes called a white label ETF service provider. The first one was Exchange Traded Concepts. And just recently, like in spring, Alpha Architect decided to become one of those guys. And so, interestingly, one of the deals is if you're going to do an ETF, you have to break the law, the 1940 Securities Act. And so to get around that, you need the SEC to grant you exemptive relief. And so they've kept a tight control over that. I think they like having nice tight control. So it turns out that if we wanted to do that ourselves, get exemptive relief, it could take somewhere between 6 months and 3 years to get that. But people who actually already have, or companies that already have exemptive relief for, let's say an index type ETF, don't have to refile for exemptive relief. All they have to do is file the prospectus with the SEC for the new things, have them review the prospectus, and then go along their way. And it turns out that what they can do, what people with exemptive relief can do, is they can set up a business as let's call it renting out their exemptive relief. So the structure actually is, and like for the first ETF that has launched called Wiz, all the information comes down through this line, and management fees, et cetera, flow back this way. But technically, the ETF actually lives within Alpha Architect. And so because it technically lives within Alpha Architect, then it enjoys the exemptive relief that Alpha Architect has. And so guys like us can, for actually, well, it's actually a lot of money, but compared to many things on Wall Street, very little money, like for less than $100,000, you can get an ETF up and running. Now, the operational costs are like about $25,000 a month to have the market makers, the custodians, and the fees for the New York Stock Exchange, and you got to have this distributor thing, which is really an overseer tied to FINRA, who has to approve all of your literature and tell you what you can say and can't say, and SEC's in here, and there's another half a dozen guys in here who you don't even know what they are, trying to be a little guy and start a thing. It's impossible to know who all these guys are and which ones are the good ones and make all those connections. But when we come in this fashion to Alpha Architect, which already knows how to do all this stuff, it makes it a very simple thing. So this is the route that we went, and Merlin AI Corporation did get started, and it did launch its first guy in October. Okay, so one interesting thing about ETF tax efficiency, I think you'll find interesting. I heard for a long time, oh, ETFs are so tax efficient, and apologize. I got kind of two things on top of each other here. I didn't notice that this slide was defective, but we can see what we need to see. So the important thing of the message of this is that what is this tax efficiency thing? Well, what is this based on? What does it really mean? So basically, what it means, if you think of bull rider, bear fighter, and it's going to have each one of the underlying strategies is going to have 5 or 6 trades per year. Okay, so it's all going to be short-term capital gains thing if you execute it yourself. But if you put it within the wrapper of an ETF, they use a thing called an in-kind exchange. And an in-kind exchange, let's see if I put this, it's probably hidden under here. Sorry about that. So the interesting deal is, you go back to, I think sometime in the 1970s, people like Fidelity and Schwab and others were wanting, as were individuals wanting, to have the ability to move money from a fund, particularly if you think of an individual. He's got a whole pile of, let's say, Fidelity Magellan, and he gets, for some reason, upset at Fidelity and says, hell with Fidelity, I want to take my toys and go over to Schwab. So to sell Fidelity Magellan becomes a taxable event. And so that gets in the way of being able to freely move to another brokerage. And so individuals didn't like that. And of course, the brokerages all were egotistical, thinking, well, if we get this barrier out of the way, I can attract more people than I'll lose. And so Congress created a thing called an in-kind exchange. So for Fidelity Magellan, what it means is you tell Magellan, I want an in-kind exchange, and they take your Fidelity Magellan shares and they convert them to the underlying stocks. So now in your account you have the underlying stocks which you actually own, and you can move to Schwab. You can't move Magellan to Schwab, but you can move the underlying stocks because you own them. There's no taxable event in moving stocks. And so the Smartskis that invented the ETF observed this and decided they would take advantage of it. So what actually happens is, so you are the investor and you buy a fund. So you're trying to trade cash for ETF shares. In between, there's a so-called authorized participant. And so this authorized participant has to get you those shares. And the way that he does that is he first takes your money and he delivers the money. And let's see, I got to make sure I understand what investor sells authorized. So authorized participant has to go and get the shares, and to do that he has to go buy, like for an ETF, he has to see what are all the underlying things. He goes and buys all of the underlying shares of stocks or ETFs, and then he delivers them to the ETF guy. Says, here's all the underlying stuff, give me ETF shares. So the shares come back to him and come back to him and back to you, and so you get the shares. So there was this transition. In order for him to get the shares for you, he had to do that. So on the way out, it's the opposite. So eventually, somebody wants to sell the ETF, and there's, let's say, excess shares being sold, and so this authorized participant has too many ETF shares. He goes back to the ETF maker itself and says, I want to redeem these ETF shares for the underlying things in kind. And so that happens, and it's a non-taxable event. So basically, if you think really long term, you buy the ETF, and there was this exchange in kind for shares that happened to get you those things, and then 3 years go on, and within the ETF, you trade all the stuff. All the sectors change, all the style box things change, all the bond funds change, and then at some point you say, okay, I'm selling the ETF, give me the stuff in kind, and then convert it to cash. And so because they did this in kind thing here, then all of the trades that would be normally short-term capital gains for you turn into long-term capital gains. This is a huge gift from the government. I don't think they anticipated it would get used in ETFs in this way, but it does. So for you, particularly if you have not an IRA or a 401k, which is already, those things are already tax deferred. But if you have a taxable street account and you wanted to implement the bull rider bear fighter, the way to do it actually would be through the ETF, where all this in-kind exchange stuff goes on, and it becomes totally long-term deferred capital gains for you. If you already have protection through an IRA, well then it's irrelevant. So that's what the tax efficiency thing is all about. Another thing I'd like to quickly mention: there's a lot of people who worry about ETF liquidity, and you think about it typically in terms of small stocks. That's not the way to think about it. It turns out ETFs are tied with steel cable straps to the underlying stocks that represent them. So if you have an ETF like this one called iPay, things like MasterCard and various kinds of banks and things are the things that iPay holds. And so liquidity, because you have these market makers behind, and because you have generally more than one market maker competing to take your trade, you don't require having another individual. It's set up so the computers automatically do it and keep the spread as thin as they can. So now this chart here is an interesting one. Back in June, around June 10th, Sector Nectar said sell whatever it said and buy iPay. And iPay had been clicking along at 111,000 shares a day on average. And on this particular day, it went to 2.5 million. And some people would say, that's crazy. You can never do that thing. You'll cause this huge dislocation. And you can see on this Yahoo chart, there's a little grass along the bottom of activity, and then all of a sudden, all of this stuff. And so individuals in Sector Surfer and advisors in Alpha Trade are trading. And it turns out I happen to know that this trade here is a trade for $30 million made by a large advisor down in Atlanta, who basically has about $100 million of client assets on the Merlin's Magic portfolio. And so a portion of that, of course, is the Sector Nectar. And so this was his trade that he made. Now, also on this chart, I also put IXICs. So in Yahoo, that's the NASDAQ 100, and I plotted it on here with it because it wiggles very, very similarly to it. And at the point where we had $30 million of trade, if you try to say that you can see any kind of a bump in here, I think you're dreaming. But this shows that this amount of money is nothing compared to the capitalization of the stocks that underpin iPay. it's irrelevant what the daily volume of an ETF is. It's all tied to the stocks underneath, and this kind of really shows that. Okay, so now as we went on in time, okay, so we had before we had the Merlin's Magic, and Merlin's Magic had a couple of things underneath it, but we wanted to develop an index for Merlin AI Corporation for the first ETF. So that was Bull Rider Bear Fighter Index, and we had advisors saying, "Oh, 4 things underneath, that's not enough. We have clients with $5 million, and I can't tell them I just put it into 4 underlying ETFs." So they always wanted more. So okay, so we developed this guy to have 8 underlying things. Okay, and what they amount to, rather than trying to look at all these things, there's a pair of bond strategies. So this thing is weighted 20% in bonds. There's a style box type strategy, a factors type strategy, a global regions, countries, and 2 different sectors things. So we picked 8 ETFs for this thing. And let's see. Oh yes, I forgot that this brought those up in that fashion. We got more? Yes. Okay, so underlying the Bull Rider Bear Fighter. So in the bull mode, as opposed to the bear mode, these are just the ETFs that are considered, and it's going to pick the best one of each of these classes. So these are different investment factors, including growth, value, dividends, earnings per share. All of these guys are in here somewhere. These guys are all a bunch of sectors, a bunch of world categories, et cetera, et cetera. And there's a limitation as to what can be put on here for the ETF. It's required that I think some of the categories go down to $100 million minimum AUM, and others are up at least $500 million or higher AUM, and this helps make advisors happy. And in the bear fighter portion of it, then we're looking at different kinds of bonds, including junk bonds, municipal, aggregate, corporate, all of them, even consider short the market. Okay, so the Bull Rider Bear Fighter Index, when it all gets put together, actually looks a lot like the Merlin's Magic, and it should, because it's a lot similar. It's put together a lot similar. There is, I said, SumGrowth Strategies have a new little portion to us called MAI indexes, and I guess this is an old slide because the Bull Rider Bear Fighter is on there already. So if you want to look at a lot of the statistics about it, et cetera, you can go there. So I want to now move to the topic of why are AI funds missing in action on Wall Street. And so if you go to EDF.com and you look for the artificial intelligence category, you find that there are all of these guys, but when you look at them, you find these 2 guys, AIEQ and AIIQ, are both from Equibot, are 2 funds that were launched, and they use the IBM Watson methodology or tool, if you will, IBM Watson tool, deep learning for picking stocks. There's another 2 that have recently come to market, QRFT, AMOM. They don't say what they're particularly using for software, but again, it's deep learning. And then there's Wiz. Interestingly, the issuer on here depends on who you're looking at, what it says here, because of the layered thing, yes, it's a Merlin AI thing, but it goes through Alpha Architect, and the name of their subgroup, which is an advisor, has a name, Empirical Finance LLC. So that's all within the layered of things. But and there's one other one here, Buzz on the bottom. So only these guys actually do trading using some kind of algorithm. All of these other guys actually use, well, they don't use anything. They actually hold stocks of companies that make or use robotics or artificial intelligence, but they don't trade using artificial intelligence. So there's only these guys. And first one of note is Buzz. Rest in peace, March 2019. It's already gone. And interestingly, on here, this is a list of assets under management. These guys have been out since October 2017. They're at 114 million. Merlin Wiz came out not August, but October. And in 10 weeks got itself up to 32 million. And then there's some guys down here, which mean they're going to fail, because it takes about $30 million of assets under management to break even with the cost of operation. And one of them has actually already died. Let's look at them a little bit. So interestingly, AIEQ, made by Equibot, using IBM Watson, trying to find the best investment. So here I've plotted it against the S&P 500. That's the what is it? Yahoo ticker symbol for the S&P 500 index, and they came out and they performed like this. And one of our partners, who is a financial advisor, actually talked to these guys a couple of months before they went live. And since then, as we've launched Wiz and talked to some media, we hear the same thing was told to the media, which was that they were expecting that they would do 70% per year. But instead they came out, and they're the green guys here. And some would say, in a technical term, there's a lot of suckatudinality going on here. And so there's a question, well, what happened there? In any case, they are a member of the Broken Pick Club. And it should be mentioned that these guys were the first to the market. Within 3 months, they had $70 million of assets under management. They climbed it up to 240 somewhere around a year out, like around here. And now they're on a steady decline. And I wonder why that might be. They launched AIIQ, an international version of the same old stuff, but international, about 9 months later in July of 2019. And it's international. So here it's measured against the Vanguard World Stocks, and you see, well, at least it's not hurting, but there's no magic there. Interestingly, AIIQ only ever had, $3 to $5 million of assets under management ever in it. It's going nowhere, and it's losing money, and it is said that it'll probably close here pretty soon. So another broken pick for some reason. Where did the magic go? Pointed out Buzz before. Buzz used artificial intelligence to find patterns in Twitter messages. What are people tweeting about? Are they going to do this, do that, or the other thing? And so here Buzz is in green against the S&P and NASDAQ. So Buzz in green. Yeah, it was there. But it had already, I don't know if they got any market, public, promotion stuff out of news articles or anything like this, but this is, again, 6 months after AIEQ was failing. But these guys never got much assets under management either. I think they closed at about $5 million of assets under management. And I don't know the story behind it, but you have to imagine that if they're using, deep machine learning and blah, 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 they must have had some good PhDs working on this, and you would not have started this unless you would have had good faith that you were going to, blow the S&P 500 and NASDAQ out of the water and do something great. But instead, they just effectively did no better than maybe randomly picking stocks from those indexes. So what's up about that? Broken pick award. Then we have BlackRock. Interestingly, BlackRock kind of halfway punted. So in March of 2018, they launched 7 AI-powered sector ETFs. Woohoo! That's going to be great. And here they are. But when you look to see what they are, let's see if I remember. Okay, so in yellow is here. It says the firm is using machine learning to parse language and public filings to determine a company's weighting in a particular sector. Okay, so this means we're going to do effectively a racial purity test. Are you really a technology company, or are you a retail company? What the heck are you? For example, Amazon. What the heck is that? What are these different companies? So they purified the sectors, and so I plotted a couple of them on here. So IETC, that's technology, and I plotted it against IYW in green. So it's about the same, maybe about a little bit worse. And IEFN, so there's the financial guy, plotted against IYF, and okay, it's kind of hanging in there, but a little worse. So you have to ask, yeah. So you gave me racial purity, which did nothing for any investor, and apparently they don't care, because these things today, after what are we? We're not that far away from 2 years out of the gate, and they average $7 million of assets under management. BlackRock can't get those things going because nobody cares. They haven't solved a risk problem, and they're still going to go off the market, off the cliff during the market crash, and they haven't given them any more return. Nobody cares. Interestingly, okay, so again, a broken pick award, and I say purified sectors are a distinction without a difference. They did not move the risk-return needle for investors. Well, it turns out that Motif Investing and Goldman basically did exactly the same thing with some thematic beta stuff, and they generated these ETFs, not exactly the traditional sectors, but they're thematic nonetheless. And after a period of time, let's see, so these are 9 months old, and after a period of time, then let's see, the red guy, G fine XLF. So the red guy is right in there with the purple guy. So again, it's about the same, but no real difference. And the data-driven guy. Okay, so the blue guy here goes up against the green guy. So again, the same story as what you saw BlackRock do. Again, the same thing. Purified sector distinction without a difference. It doesn't do anything for investors, and they're also failing to they stay like this. They're either going to be supplementing it with about $20,000 a month of their own money, or they're going to drop it. They either got to raise the AUM or drop it. But they haven't done anything for investors. Okay, so what's going on with those things? Why are they failing? And here's my take on it. Um, they're trying to solve too many simultaneous problems. Remember in the beginning I said, we'll accept this, we won't reinvent this. We'll accept this, we won't reinvent this. So the whole signal to noise ratio thing, it's really important. Are we going to have IBM Watson deep learning discover that signal to noise ratio is important? And not only is it important, but now that you've discovered that it's important, what are the means for improving it? How are we going to use matched filter theory? Is it going to discover matched filter theory as well? Is it going to discover differential signal processing? If you're not going to get the noise out, you're probably going to do the same thing as AIEQ and Buzz did, which is just, pick random stuff. There's also a bear market, it's a different problem. You have to just discover that bear markets have a different character. And when you get in them, you need to treat them differently by getting into the defensive things. So you need to first discover that it's important. You need to discover how to get out efficiently. And then you need to discover that you need to do something differently with the defensive stocks. So between all of these things, there's too many simultaneous problems to solve. I can't believe you can throw this to anything and say, develop all of these things at the same time. And there's one other big problem. And interestingly, asked Wesley Gray, CEO of Alpha Architects, PhD, momentum guy. He came out from underneath Eugene Fama, was his advisor at the university. And so one of the times I was out to see him, I said, hey, Wes, what do you think's going on with AIEQ and Buzz? These guys had to believe they had something going on here, or they wouldn't have done anything. Why do their things fail to perform? And he surprisingly said to me, without skipping a beat, he said, Scott, every time I've looked into this, I had no idea he even ever looked into it. He said, every time I've looked into this, where there's too much excess or a lot of excess performance coming out of things, you need to go into the neural networks and see what messages are flowing from node to node. And it's a very difficult thing. It's very complex. It's inventing its own stuff. And you need to figure out what messages are being sent around. And he says, every time I've seen this excess performance, it always comes down to the future leaking into the past. The networks are connected in a way where that can be possible. You have to prevent it from happening. But he's seen every time that's happened, it's a problem. So if in fact this was a problem for Buzz and AIEQ, then I can imagine how they could have believed in testing. So, since I don't believe any of these guys ever ran anything in real markets with a subscription service or anything, they did their testing in the lab and went to market. And so they probably had future leaking in the past. They believed they would do great, but when they had to go real time and there was no leakage, then they came up against the signal to noise ratio problem, which they didn't actually have to solve before because they had a leakage problem. There's also a second source. There's a PowerPoint presentation I got from Zach's regarding he and the guy there and a partner of his researching what's going on in academic studies in finance for with neural networks, and they found this is also a problem with what they've found in academic work. So I don't know if these are the problems, but if I were to say what is the problem with AIEQ, what's the problem with Buzz, and also I didn't get the chart of this out here, but the way up here on the original guy, one more. There were these QRFT and AMON. These guys came out in May of 2019. They're a Korean company. They're using some form of artificial intelligence. If you go and look these guys up and compare them to the market, they seem to be suffering from the same disease as AIEQ. So I have no idea what their background of testing is, but it seems to be prevalent so far. So just refreshing again, we don't use neural networks or machine learning. We don't have the leakage problem. We have a lot of individual problems that we take an individual tool to go and solve it. We didn't ask anything to go solve all of these things. We applied straightforward technology that's well, I guess this last guy was not straightforward, but most of these other things are straightforward tools known to signal processing engineers, loop control engineers, and these kinds of things. The right tool for the right job, and you attack the pieces, and piece by piece, as I showed you in the sequential charts, you get there. So one final little thing. The foregoing material was rather technical, and as we try to communicate it in the market, we've got at least two different audiences to talk to. The technical people usually want the juicy stuff, and the rest of the world, their eyes glaze over. And so when you really look at what we've done, we've decided to address it or describe it in this way for the Jacks and Jills of the world, which is most of them, and that's that the bull rider bear fighter is a paradigm shift in ETF design, and it was designed to do the 5 things that investors want most. And what that means is in bull markets, own a set of momentum leaders. In bear markets, own a set of defensive leaders. You evaluate bull bear with multiple risk measures efficiently. So make that choice efficiently. Give me tax efficiency. So, I want the long-term capital gains. And I want it fully automated so I can go have a life. Let's get away from the screen and go fishing with the kids. So this is the style of the message we're taking for bull rider bear fighter to the general market. We're going to have excuse me, an interesting second. I probably shouldn't talk about this, but I will anyway. So the first 30-second ad that we had, and you can find the 30-second ad if you actually go to the ETF site. So like ETF.com. So WizETF.com, you'll see the video there. You can play the video, and it's a fun little thing about evolution and ticker symbols. A guy made a great little thing, but it's kind of designed to hit technical words that us technical people like. The second one will be more of the form of an interesting car guru's ad I like, where this guy's eyes are glazed over, looking at what he's got pinned up on his board in front of him of all these different cars, and then all the different places where he could get these cars, and the wife comes in and sees him all glazed over, and she helps him out with the little car guru's thing, and shows him how easy it is to actually go pick his car and go get it. And she says, "Oh, that was easy. I'm beat." And the guy's eyes are blurred over. And anyway, so a takeoff on that is we'll have him with guy's eyes blurred over with all these different charts, and instead have the grandchild come in who's tech savvy and has heard about the bull rider bear fighter from mom or dad or something, and come on, grandpa, come out and play. And so we'll make an ad like that, probably mostly to show on CNBC. So again, in terms of the paradigm shift, so here's a couple of ETFs and some robo-advisors. So with these 5 things, what do they have? So in bull markets, they own the momentum leaders. Yes, SPY, you know what that is. That's just a sector guy here. AOA is, what is AOA? Aggressive allocation. So yeah, so that's an 80-20 allocation. It's just static, nothing going on. PDP and FV are both momentum strategies. So yeah, they are owning momentum leaders. Betterment and Wealthfront don't do anything like that. They're automated modern portfolio theory, basically. How about bear markets? Do you own defensive leaders? None of these guys do. Do they even know when it's bull versus bear? No, they don't. Can they do the long-term capital gains thing? Well, yes, they're in ETFs. They can do that. Although these guys do occasionally shift the ETFs. So if you're buying and selling their ETFs, then maybe that goes away. And do you have automation so you can set it and forget it? Well, Betterment and Wealthfront kind of do. But Wiz does all of these things. The bull rider bear fighter is designed to do all these things so that you can actually set it and forget it. In fact, I've moved everything that I can of my own stuff over into it, because as much as sector surfer is kind of easy to do compared to a lot of things, still there is the need to pay attention to it, and I've got I personally have a lot of things to do at the end of the month with the biz and extra questions coming in, and so now it just happens for me, and I got to tell you, I'm loving it, having to set it and forget it. So as our good buddy Albert says here, so if you want different results, don't do the same thing. You gotta do different things, and that's what we do. We do a lot of different things, including still using modern portfolio theory. Mind you that each of the ETFs, each of the underlying ETFs, starts with broad diversification to get rid of the individual company problem, and then ends with another layer of ordinary diversification by having the divergent strategies rolled together and further smooths. So we are definitely different than those other guys. So I just made these for some of our team the other day. And so how's the bull rider bear fighter actually doing? And so, you know, the fairest way to do this is not through the index itself, but okay, let's look at the Wiz itself. So this is against other 80-20 allocation funds, which is the proper benchmark, considering we're always carrying a load of 20% bonds around with us with the bull rider bear fighter. And so there's the iShares AOA, the BlackRock 80-20, MFS growth allocation, and Franklin growth allocation. And if you look these things up, they're all 80-20 guys. So the red guy here is bull rider bear fighter. White guy is the S&P 500, and those are the other guys. So one other interesting comparison is here. If you look down through all of these things, all of these guys are momentum ETFs, and they aren't 80-20. They're all 100% equities. And the only guy in here that's not a momentum type ETF is the green guy here, the Dow Jones Industrial Average DIA. So here we have, again, with red being Wiz, we have the S&P 500 here. The red guy comes next. Dow Jones Industrial Average is down here, and all these other momentum guys are here. So I guess we're happy. No, I don't guess we're happy. I know we're happy. And so that brings us to the end about the bull rider bear fighter, Merlin AI, a paradigm shift in index design. So that was a whole lot, and I think your microphone is on that end. So any questions?
Can you hear me?
I can.
Okay. I'm sure we got some questions. One question I've got to start with is one of those strategies that Wiz is a totally automated picking system, right?
Yes.
So, I mean, it can be back tested to 2000 or whatever, right?
Yes. When we somewhere back over up here, I'll go get the. Oops, I think I just went past.
That's what I did.
So this guy, I think it was right here. So let me just say that back testing. So 2005, 2004. So this begins in January 2nd, 2004, and from here forward, it is forward tested. There is a period of time before 2004 where there's less and less ETFs, but some of the ETFs go back into 2000 and 1998. So the period before 2004 is technically pure back testing, and I don't show any of the pure back testing part here. It's got a little bit of smudge on its reputation. Sometimes it's okay, but it can falsely say things. So in this thing, then the forward walk progressive tuning, the forward walk through the data, and the forward walk progressive picking, the evolution month by month of what are in the strategies. So all begins. So 2004 forward is all forward walk for the candidates and forward walk for the tuning of the algorithm.
Okay. All right. Anybody? I know we had another question back here. Why don't you come up here and ask?
Mine's got.
No, hold on. Come around here so you can hear.
It's got to have a very extensive signal processing type activity. So this is
I'm sorry. Can you speak up a little bit? I'm barely getting it.
Can you hear me now?
Yeah, better. Thanks.
Okay. But I was really interested in your talk on tax efficiency. We're right a few days before we have to make our last estimated taxes for last year. And so I've really been into that. And the thing that I've noticed over several years on my investments, it seems like all the ETFs are almost always, now you might tell them you have to pay long term or short term, but it seems like all the dividends and things like that, distributions end up being long term. I'm just curious, is what you showed here something that's very commonly used, or you have to pick them, or
yeah.
Could we do better in our tax efficiency?
Sorry about that thing again. But all ETFs operate with this tax efficiency thing. With this, they're designed to have this authorized participant, this market maker guy in the middle who does this thing, and interestingly, so some little minor stuff. So these authorized participants actually have to buy the ETF shares in so-called creation units. So they got to buy 50,000 shares at a time, so they come in and out. And so back here over at the ETF, then you've got the so you've got the custodian, the bank. So the custodian is holding the money and the shares of things, and shares get flow out this way, and the market maker comes in with his underlying share, flows it in this way. So interestingly, I learned more and more little pieces. But at the end of the month, when we have a so-called rebalancing, I never liked the word rebalancing, because that to me just means a slight tweak of going from in the percentages. But here we're doing radical rebalancing. So in order to do this at the end of the month, when we do all these trades, there's and you can probably there's places where you can see this. Like you can see it on Yahoo. If you go to, I think it's like the 3rd of the month. Was it the 3rd, 1st, 2nd, 3rd? So at the end of the day on the 3rd. Well, let me back up a second to explain this. Some other interesting logistic is we can't preferably tell one party information about trades ahead of other parties. And so it turns out all parties, the index publisher, Merlin AI Corporation, and thus Alpha Architect, as well as SumGrowth Strategies and AlphaDroid, everybody who's tied into the bull rider bear fighter, the information becomes available at the same time. Interestingly, sector surfers and AlphaDroiders wake up the next morning and there's the buy and sell, and if somebody wants to go execute it early in the morning, they can. But when you come down this path, then I do a specific review of the information that goes over to Alpha Architect in the morning, and well, we're West Coast time, and they need to by 5:30 East Coast time, which is 2:30 our time. They need to have over to the custodian the list of all the trades and what's going to happen, and so Alpha Architect goes through it and has to decide which things are trades, which things are not, and get their list over there, and then they make their plan, and part of their plan generates a huge amount of trades. So on the third, at the very last moment of the day, you'll see 900,000 shares of the ETF exchange, and it was done in a mode where, in order to do this exchange in kind, they do a quick buy, sell, transfer, back and forth, bunch of farfless of the blowhole. So in order to do the tax efficiency thing, and the fact that we've thoroughly traded out half of the stuff, there was a spike of 900,000 shares that traded. But it wasn't real trades to people. It was trades to execute this exchange in kind to get the tax efficiency thing. And so this is a standard practice. We're just making use of it probably to an extreme method than anybody before.
It's a standard method among most ETF operators, right? Would that be a fair statement?
It is the standard method. So all of these other things, like the Dorsey Wright Focus 5 through First Trust, the same thing occurs there, and other momentum. There's a lot of momentum ETFs out there, but they're generally, we'll slightly tilt the playing field. We'll 10% overweight this thing and 10% underweight that thing. So they're doing the same thing. But to a lesser degree.
Let me ask you one other question. It seems like I've noticed that in my end-of-year stuff, you have to do estimated taxes and you have to make the best guess how to allocate things before you actually pay the tax on it. But I've noticed it seems that when you get to the actual 1099s on everything, it seems like bond funds often can't. Bond funds, I don't know if it's funds or ETFs, they're mostly funds, but or ETFs don't seem to be able to do this tax efficiency.
So there is one little other piece that's been mentioned, but I didn't say anything about. And in fact, I only learned about this myself just shortly ago. There was some discussion internally about dividends, and because we're talking about shortly here, maybe the end of this month, early next month, we'll launch a little sister of Wiz, which will be more conservative, and then after that we'll come out with a more aggressive one. because I know some of you guys are wild ass like I am and want them more aggressive. And anyway, so in thinking about it, the question came up about the dividend thing, and some of our underlying ETFs have dividends. It turns out almost all ETFs produce dividends, which was a surprise to me when I learned that a couple, maybe about 10 days ago. And in fact, Wiz actually produced a dividend at the end of the year. So the dividend thing always comes out. The capital gains thing is where you're protected.
Which you get long-term consideration on.
So maybe the bond funds are producing a higher percentage of their stuff in dividends.
And there's no tax on the first $77,000.
I'm sorry, I couldn't quite hear that.
Scott, there's no tax due on the first $77,000 of gains in long-term capital gains.
He says there's no tax due on the first $77,000 of gains in capital gains. That
Zero tax.
For you, not necessarily. Yeah.
If you look at the, well,
Let's just say I'm not a tax expert. I know pieces, and I'm learning more pieces, but the tax code and how it's even, some things are treated differently in different states, and then your own situation. But so there's other rules. I can't speak to what he's talking about, but at least in terms of generating a taxable event, the trading short-term events become long-term events so long as you continue to hold the ETF.
Scott, I apologize. I wasn't trying to get you to give us tax advice. I was just sharing personal knowledge. If you look at the capital gains tax rates, and I'm not asking you to, it's just something that I've looked into.
I appreciate that. Thank you.
The first $77,000 of long-term capital gains has a zero tax rate. That's, if we have a Democratic administration in 2020, it's probably going to go away.
Oh. Yeah, I've so much relied on TurboTax. A lot of those details get hidden from me.
I don't disagree. There isn't zero tax.
I believe it is. I believe it is for married filing joint.
So anyway, an interesting thing is as we're trying to figure out where best we can get attention with the ETF, appears to be, there is a problem associated with, but the people who have had businesses and have sold businesses generally don't have the money in an IRA or 401k. It's in some kind of taxable account. So the so-called family wealth advisors probably are a good place for us to go with this, because in effect, it becomes like a new 401k where you can, or IRA where you're allowed to do the trading, and it doesn't become short term. But unfortunately, we've talked to two big advisor family wealth people so far, and they're so ingrained in modern portfolio theory, and that they've seen anything, and this can't possibly be true, or I would have seen it before, and they just, you can't go anywhere with these people.
Okay. I've got a couple questions here. One is, when we're looking at the bear fighter or the bear bull rider, bear fighter, you have 8 different portfolios. Are those portfolios doing the same things that are being done in Sector Surfer, where you're picking only one ETF to own, and then it's divided out by the percentages you showed for the total?
Exactly. And in fact, all of these underlying strategies here are available on Sector Surfer.
Right, but they're picking only one, and then they're divided out by the percentages that you showed as like 10%, 10%.
Yes. If I go over here, so here's a Sector Surfer page. So here I've got a bunch of the Merlin, and in fact, here's one of the Bear Rider, Bullfighter guys. They're all in there as so-called master strategies, which means you can access them, but you can't edit them.
Right.
Okay, so the end portfolio is made just like I made here with the Merlin's Magic thing, where I have to roll it up into the portfolio and then tell the weighting, and there's information about how to make portfolios in case. So on the advanced topics page, the first thing in the upper left is for making a portfolio that shows you how to do the little cryptic.
Yeah, I understand that. Wiz does all that for you, and you just buy the ETF. And it takes
That's right.
It takes those 8 that you showed, buys a single one of each one of those 8, allocates those by the percentage, and then that's what Wiz is. Is that correct?
Yes. And so what I just did here, just to show you, BRBF, Bull Rider Bear Fighter, I put that in the name of all of the strategies. So these guys are all of the same strategies that you see right here. So you can implement it on Sector Surfer, or you can go have a life and have the ETFs just do it.
Okay. Then one of the things you mentioned earlier was about a 6-month and a 12-month look-back period. Or is that something that the AI looks at to try to decide which look-back period, or do you just settle on 12 months?
Let me back up here just I think. Okay, so way up here, there we go. In the beginning, we talked about the simple moving average.
Right.
So, which is the 12-month period in this case, as shown, is the so-called look-back period. And what I'm saying here, according to matched filter theory, if you're saying what is the best way, what is the optimum way to have a look-back period, if you will, or a filter, what is the optimum way to have a look-back period that most accurately represents the probability of the thing performing well in the future? And it turns out there's mathematics for that called matched filter theory, developed in 1948 or something like that by this guy. Had to do with radar signals at the time, and when you all the information is in the book and on the site about this, but basically it turns out that this has started, excuse the expression, but somebody just pulled that out of their butt.
Yeah.
And nobody changed it for decades, and it is a poor choice. It is a very poor choice. And so what I'm showing here is the general shape of, it's not exactly like this, but it's very, very close to this second order exponential moving average, or the double exponential moving average, which if you will is like to say it's like the exponential moving average then fit into the exponential moving average again. So like doubly filtered beer. And when you do that, you end up with something like this as opposed to this square thing. And they started out with with Model A's, but they don't go down the freeway so well at high speeds. Curvature was required for that as well. And things I'd just say for those of you who are technical in there, when you're shifting this across time, across the ragged data, these sharp edges actually suddenly go from bringing something in to and taking it out. Those sharp edges drag noise into the momentum filter, into the look back. Sharp edges are a bad thing. So we don't use these. We use something which is a second order exponential moving average, and it turns out that the period of time of this actually is very different for different kinds of strategies, because you wouldn't expect that the time constants involved with bonds would be the same kind for, let's say, large cap indexes, which would be different maybe than individual sectors, and on and on. All of these things have different character. Assuming that they're all going to be perfect with a 12 months simple moving average, really? That came down from God or the universe? No, it didn't. It's wrong.
So what you're saying is each individual strategy has a different look back period based off of what you're actually looking at.
Yes, and there's, well, since I have this up, I can actually probably show you quite quickly. On let's grab a real strategy here, like Spider-Man Gold here. So I click this blue H thing here, and it gives me this download summary data thing. It's going to bring up a spreadsheet that has a whole lot more stuff in it. Let's see if we can get the text a little better. So it has a bunch of stuff for different periods of times, and then all your blah blah blah, and then here's all your trades, and underneath all the trades, eventually let's maybe expand those out so they're not, so they look like real dates. Okay, so in here, okay, so in the progressive tuning way that says month, or actually every 6 months. Every 6 months, the algorithm is allowed to look back in time for data that's already history, and it says using this stuff that's already history, we're going to look at how well the strategy tunes with different we call them lookbacks. They're not exactly lookbacks in terms of SMA, but it extends or shortens the width of that curvy filter, and there's a primary time constant. And so here's the time constant in days, and the rank of them now. This is how well the strategy performs with each of these things. So the strategy is performing best with about a 57-day time constant, which means that rounded hump is somewhere around 57 days. And it looks like that was the first one. There was the just for information, was the similar rank measured at the time on the born on date. So right at the very beginning, this was the tuning profile, and it changes over time generally because you put more ETFs in there, that some of them are only 3 years old or 8 years old. So as you put new people on a playing field on a sports team, the way that the team plays best changes. And although in this case it looks like the peak in both cases is around the same period of time.
So this that you're showing us right here is to find that peak where that race car was.
Yes, and here are some dates. These should be going about 6 month intervals here, and in the 6 month intervals, then it says what is that days that time constant for the peak of that hump, and how has it changed over time. It looks like it started out in the 50s, and it went down into the 30s a little bit, and now it's back up into the 50s. And so it's just adapting to either changes in the market's behaving a little bit different, or because of the nature of the ETFs that have been added in. You can also change that.
All right.
Will we get I know you're recording this, will we get a PDF of this presentation?
I missed part of that question. Will you get?
Well, we're recording it, so it'll be a link or something we can go watch the video. Is that right?
Yes, there'll be some. I'll post it somewhere, or there'll be a link, or God forbid I have to send 3 gigabytes down to Dan.
Yeah. Will we get a PDF also of the slides?
Absolutely.
Thank you.
Okay. All right. Any more questions? Okay, one more question.
Scott, can you hear me now?
Yes.
I found your presentation kind of interesting because if you go from an engineering perspective and take a look at what's going on in the artificial intelligence technologies and applications, it seems to be all going down the machine learning, deep neural network type activities.
Yes,
And they seem to be the ones that are coming to the top in terms of most applications. And also, it's kind of interesting that you go look, say, in the Python books that talk about how to program those things. They're also saying that it takes 40+%. In fact, I had a professor at one of our local universities tell me that it's more than that to just get the data prepared and pick the right features to do all that. And I'm just curious, do you think that we're ever going to get where we really get the true machine learning neural networks type algorithms, or is it going to be the higher level artificial intelligence where you kind of pick stuff and do it?
Yeah, so you could get there, but I don't think they can get there the way they're going. And so let me make an interesting analogy. So we have in the medical world the staph bacteria that's getting worse and worse, and they can sometimes hardly find anything that'll kill certain strains of it. And this could become a really big problem. And they've had drugs they've used before, but if the drug only kills 99.9% of them, then eventually that 0.1% of them mutate and evolve, and pretty soon they become resistant, because those are the resistant ones. The partially resistant ones are the only ones that are surviving, and so pretty soon they're all resistant. And so the strategy they're using, and trying to go somewhere with, if you've read up on this a bit, which I find real interesting, is they don't want to do that again, because they've made improvements, and they just get knocked down by the evolution of the bacteria. So the better thought, they believe, is to attack 2 things at one time. So if you, let's say you attack the sheath of the coat of the nucleus of the, blah, 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 and another one you go after a mitochondria thing. So if each one of these 2 attacks does in almost all, but not all, things individually, then in order for anything to survive, it has to evolve 2 answers at the same time. And if you don't have a mutation that happens that solves both at the same time, then the scientists win, right? Because you can't defeat both of the things. You can only have a small chance of defeating one and then grow from that, but can't do both, at least not in our lifetime. So now you come back over to this thing, and if you say job 1 is the signal to noise ratio problem, and so first, if you're not going to give this thing information to start with, you're going to say, here's all of this data, and you read the articles that show up, and the the Wall Street guys, the hedge funds and stuff that have tried this, they all moan about how the market is so noisy and and there's problems for correlations, and correlation algorithms can find correlations in noise that you think are real, but they're not, and their performance has been sucking really bad. But never once have I read an article where anybody says they're actually addressing the noise. Get the frick noise out of there. Job 1 is reduce the noise. Job 2 is reduce the noise. If you're not going to reduce the noise, then you're just playing in this mess. So first, if you're not going to go talk to the electrical engineers and know that signal to noise ratio is important and somehow embed that in, if you're going to just say, here's a pile of data, machine learning, go figure it out, and you're asking it to develop signal to noise ratio theory, first develop and determine that this is important. Just determining that it's important doesn't mean you've solved the problem of what to do about it. Now you've got to go do matched filter theory, and you've got to have it developed differential signal processing. Oh, don't forget that the bear markets are terrible, and you better figure out how to get out of Dodge. And once you get out of Dodge, you know, what are you going to do? You know, now you have to have it invent bear market strategies and how to do that. There's just too many things for neural networks to invent. And until they break down the problem, and you know, maybe they can do it in a way where you send the neural network after each of these individual pieces, where each one has a job to do, and they combine together to form a result. Maybe there's some progress there, but as far as I can see, they're not taking knowledge that exists and giving it to it. Maybe again it's because not even the academic paper guys. You go read the momentum stuff from all the academic papers. They have no concept of the signal to noise ratio thing and what the solutions are, and that you should do something other than an SMA. Once in a while you'll see an EMA, but not a single paper knows anything about matched filter theory. So if you want the genetic algorithm to discover all of those things simultaneously, it ain't happening. If you can break down the problem and make a tool for each job, then maybe you can do something. But that's not what they're doing. That's my wild ass attitude on it anyway. What do you think?
Yeah. I agree. I agree. One other question. When you go back to your Wiz performances, you have the bull rider, bear fighter graph. No, he'll get to it.
That's the one after that.
No, back up. The composite graph. There you go. You said earlier in the question and answer, you said you had a look back period of 6 months. And one of the things is we've been going along for a long time, and now the market's leveling off. And you seem to be going into the bear strategy from the bull strategy pretty quick. And my guess is that's the storm guard armor turning that on and off. How often does that look to turn that on and off to make sure it's quick enough?
Good question. But first, I would say we don't have a 6 month look back. 6 month look back to me means simple moving average. We use that second order exponential moving average, that smooth curvy thing that was over the top of that little race car image. Remember that?
Yeah.
So if you think about in a bull market, like in this period here, we're all about let's say equities, rotating between the equities, different sectors or different large cap versus small cap. So when you're in this period, then there is a best amount of time. Here, this is an important thing. I'm going to take you to a quick little chart, which is going to help explain this thing. this guy right here, and this guy's gonna change color here in a second. Okay, see this curve here, where there's this optimum. Let me explain what that is. So the white curve across the, I can't stop this thing here. It's an animated GIF here, but so across the bottom is the averaging days. So that's the time constants of the filter, and here's the annualized return of a probably a Fidelity sector rotation strategy. This guy here, and this is just demonstrating a second part. But I want you to focus on this hump here. Okay, so what this hump is telling us is that the faster you want to trade, the worse the performance gets, and it turns out that's because of whipsaw. Sharp drops often snap back. So if you want to go faster, you're shooting yourself in the foot. But at some point, if you go slow enough, then you get on the backside here where you're missing the trend. The trends only last so long. So there's some optimum period in the middle for that. So in terms of sector rotation in the bull market, you want the thing to figure out what is that optimum period of time. And typically on a sector rotation, that would be, the peak of that curve would be much like this, around 20 days. If you get noisier things like real estate and some of these other things in there that can sometimes push on out, or commodities that can push on out to 60, 70, 80 days. Sometimes you see a hump out there, but for good sector rotation, it's usually sort of in there. So that's like one piece of the puzzle. But then you've got this Ubermaster, the bear market the Storm Guard. Let's see. So Storm Guard. Let's see this guy. So you've got Storm Guard, and it's got three things. So here's kind of a view here of during period of 2010, and this is a fractional year, 2010 through 2012, showing a period of time when. So this was when we had the S&P U.S. debt downgrade, and here I'm looking at the three different major components. Price trend, which is like a 50-day second-order moving average of the S&P 500, and it didn't head on down until after the market actually went down. It went down because the market went down, but it went down in hindsight. And,
Right.
And the sentiment, the guys doing the highs and lows, they were doing the same stuff. But interestingly, the institutional players, the high volume guys, they had sagged, and they were gone a month and a half earlier. Whatever they were seeing, maybe they were seeing this problem starting to surface. And as I like to say for these things, here's one down here where the sentiment guys are out before. So it's like a poker tells. These types of investors are seeing something, and they haven't necessarily sold stuff, but it's like they've stopped doing stuff, like they're standing at the door waiting for another shoe to drop. And if it's good news, then they say, God for that. But if it's bad news, they might be out the door, leaving you holding the bag. So it's a point in time when you see this happen where there's asymmetric risk. Market may not have gone down yet, but the risk of something, a blip shooting you down, is much higher than the risk of something shooting you up. And so it's a sign to get out. So we got these kinds of things that are measuring these things. And this is always going in the background. And so these things combine together to create the overall. Here's the overall Storm Guard armor thing, and the rule for a Storm Guard armor is if well, there's lots of rules, but the simplest of the rules are if any of these guys is below zero and headed down at the end of the month, then we're out of there. And so in this case, this guy would have left at this point in front of whatever this 2015, that was the Chinese fire drill. And this is the S&P debt downgrade. So this guy was below a whole month ahead of that, and so it says get out. So that thing has this logic of that. There's also pieces of logic for how to get back in when these things are rising. It turns out that there's a whole lot of rules for getting back in, because usually, again, getting out is some deterioration before the shit hits the fan. But getting back in, often there's a thing that's, let's say, something like the fourth quarter of a year ago, where things it was Trump, China, and the Fed. Right, they've been the moving story for a while here for some jerkuloid movements, as I'll call them. But in the case of that fourth quarter, things are looking worse and worse and worse. And then what was it, the day after Christmas or something like that? The Fed says, "I got your back. I'll move to defend the markets," or something like that. And the market says, "Woohoo!" It came shooting strongly back. So it turns out there's a couple ways over time that you can see this kind of effect happen in the market, and rather than wait a long time, wait fully to the end of the month to come back in, if you see something where there's this extremely strong rebound, the evidence is that anytime you see something as strong as this and in this way, or there's a couple measures, then you know for sure that it's over with, and you should get in now, not the end of the month.
Yeah, so from what I gathered from what you said, in a shorter thing, is when you're in a bull market and storm guard armor is off, you're using that trend signal to stay in or to change your look back period. But then at the end of the month, when storm guard armor hits one of these three are down, then you're going to the bear market strategy until one or two of those go back above zero again, and then you're back into the trend signal stack.
Yes. So
because if you remember a long time ago, you had a real problem with this, and then you did storm guard and storm guard armor and all this, and now you've gotten to the storm guard armor now, and the curve is a lot smoother than it used to be so far as in and out, and that's the reason I asked the question.
The curve, when you say the curve is
your overall portfolio curve is now much better because you're using storm guard armor to get into your bear market strategy, and then you get out of your bear market strategy with storm guard armor, flicks it back on, and then you're back in your normal strategy. You don't have those large.
You're right.
Flat periods.
And to that point, actually, it turns out this guy, looking at it, turns out he's using the death cross and cash, and so that's not so smooth. But if we go back into him, where was he? I guess he was this guy, and go to Storm Guard Armor and put in bear market strategy W. That's the one we use in Wiz, for example, and put that guy in there, and then look at him. Yeah, that's a lot smoother.
Yeah.
Number one is to find a way to detect these things that are risk to the downside. Get out of Dodge early enough. and get, and capture some of that, when it's coming back, if it's coming back really fast, get the hell back in if it really is over with, because when the Fed speaks, don't fight the Fed,
Except when they actually now have now not started raising interest rates.
Okay, well, I think we're at the end here, so let's everybody give a big hand to Scott. And we sure appreciate it, the time you've taken, and it's been very interesting presentation. And we're looking forward to seeing the video of it, so we can go back and look in more detail at some of the things we might have missed.
Okay.